Welcome to the topic on investment and types of investment. By the end of this topic, you will be able to define the term investment, identify different types of investments, identify the need for a Demat account and a mutual fund account. Investment is the act of putting money, time, or resources into something with the expectation of obtaining a return or profit in the future. In financial terms, it typically involves purchasing assets such as gold, silver, stocks, bonds, real estate, or starting a business with the hope of earning a profit over time. Let us understand why investment is necessary. Investment is very important in everyone's life. There are several reasons why you should invest for the future. The main reasons for investing are as follows: beating inflation, setting aside money for future expenses, raising funds to fulfill life goals. Inflation refers to the rate at which the prices of goods and services increase over a certain period of time. Generally, inflation is measured on a broad scale, such as the rise in the cost of living or the general price level in a country. Example: in 2014, the price of milk was 48 rupee per liter. In 2024, the price of milk was 70 rupee per liter. The increase in prices is called inflation. You also set aside money for future expenses like your child's higher education or regular health checkups. Invest to raise money for fulfilling life goals like buying a home or traveling around the world. There are various types of investments such as fixed deposit, recurring deposit, government savings, pension schemes. Let's understand them in detail. Fixed deposit, also known as term deposit, is an amount deposited in your bank for a specific period on which the interest rate is predetermined. At the end of the term, you get back your initial investment along with the compounded interest. Another name for FD is term deposit. A recurring deposit, also known as a recurring deposit account (RDA), refers to making repeated deposits over a fixed period of time. Many banks offer this service, and it allows customers to save consistently and earn substantial returns on their investment. Government savings. In India, the government provides several schemes for the savings of its citizens. Some of the schemes are as follows: Senior Citizens Savings Scheme, Public Provident Fund Scheme, National Savings Monthly Income Account Scheme, and Post Office Savings Account. Pension schemes. The Atal Pension Yojana (APY) is an Indian pension system targeted at workers in the unorganized sector. At the age of 60, subscribers of APY will receive a guaranteed minimum pension of 1,000 rupees, 2,000 rupees, 3,000 rupees, 4,000 rupees, or 5,000 rupees per month, depending on their contributions. Any Indian citizen can enroll in the APY scheme. There are other types of investments as well: stocks, bonds, real estate, mutual funds, ETFs, exchange-traded funds, savings accounts, cryptocurrency. Stocks. Investing in stocks means owning a portion of a company, offering the potential for profit through capital appreciation and dividends. Bond. Investing in a bond involves lending money to an entity in exchange for regular interest payments. They are considered more stable than stocks. Real estate investment involves owning property for rental income or appreciation, providing both a steady income stream and potential profit on sale. Mutual funds pool money from investors to create a diversified portfolio managed by professionals, providing access to a variety of investments. ETF, exchange-traded fund. Similar to mutual funds, ETFs trade on stock exchanges, offering diversification and flexibility to investors. Savings accounts in banks are low-risk, interest-bearing options that provide a secure place to deposit money with modest returns. Cryptocurrency, like Bitcoin and Ethereum, represents digital assets with the potential for significant returns along with high volatility and risk. A Demat account is an electronic account that holds your investments in digital format instead of physical share certificates. Some of its key features are digital ownership. Your shares and investments are like digital files instead of paper certificates. Easy transfer of securities. You can easily move your investments between different digital accounts when buying or selling. Reduced paperwork. There's no need to keep track of paper certificates. Everything is handled digitally, reducing the chances of losing important documents. Real-time access. You can check your investments online anytime, seeing how much you own and your recent transactions. Pledge and hypothesis. If needed, you can use your digital investments as a form of collateral to secure loans. Nomination facility. If something happens to you, you can choose someone to receive your investments, ensuring they go to the right person. Opening an account. Begin by opening a Demat account with a registered depository participant or DP. Digital storage. Your Demat account stores your investments digitally, replacing the need for physical certificates. Buying securities. Purchase stocks, bonds, or other investments and hold these assets digitally in your Demat account. Selling securities. When selling, your broker uses the Demat account to transfer ownership to the buyer, and you receive the sale proceeds. Online access. Access your Demat account online anytime to check investments, recent transactions, and performance. Corporate actions. Dividends, bonus shares, or other benefits from companies are credited directly to your Demat account. Security and protection. A Demat account employs secure technology, functioning like a digital vault with multiple layers of protection. Nomination process. Nominate someone to inherit your investments, ensuring a smooth transition in case of unforeseen events. Cost-effective and efficient. Managing investments becomes cost-effective and efficient, eliminating the need for physical paperwork. Closing an account. To close your Demat account, submit a closure request through your DP, and any remaining securities can be transferred or sold as per your instructions. A mutual fund account is an investment vehicle that pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Key features. Investing together. A mutual fund is a way for many people to pool their money collectively. This pooled fund is then invested in various types of stocks, bonds, or other securities. Professional management. Skilled professionals, known as fund managers, make decisions about where to invest the pooled money. They analyze the market and aim to grow the investments. Easy access to money. Investors can buy or sell mutual fund shares on any business day. This flexibility allows them to access their money relatively easily. Affordable for all. Mutual funds make investing accessible. Even with a small amount, individuals can become part of a larger investment pool. Regular updates. Investors receive regular updates on how the mutual fund is performing. These updates include information about the investments held by the fund. Investment diversity. Mutual funds come in various types, allowing investors to choose based on their financial goals and risk tolerance. Investors' participation. Investors buy units of a mutual fund, thereby becoming partial owners of the fund. Each unit represents a portion of the fund. Professional management. Mutual funds are managed by professional fund managers who make investment decisions based on the fund's objectives and strategy. Diversification. The fund's money is diversified across various securities, which reduces the risk compared to investing in individual stocks or bonds. Types of mutual funds. Mutual funds come in various types, including equity funds, bond funds, and hybrid funds. Net asset value, NAV. The price of a single share of a mutual fund is called net asset value, NAV. The NAV value is calculated by dividing it by the number of shares. Buying and selling. Investors can buy or sell mutual funds directly through the fund house or an agent. Pricing. The price of mutual funds is determined once a day after the market closes. The NAV is calculated based on the closing prices of the securities in the fund's portfolio. Fees and expenses. Investors may be charged fees such as management fees and operating expenses. These are deducted from the fund's assets and affect returns, dividends, and capital gains. Mutual funds may distribute dividends and capital gains to investors. These can be reinvested or paid out in cash. Redemption and liquidity. Investors can redeem their mutual fund shares at any time. The fund must have sufficient liquidity to meet redemption requests, which is generally not an issue for open-end funds. Fund performance. A mutual fund's performance is measured by its returns over time. It reflects changes in the value of the underlying securities. Regulation. Mutual funds are regulated by financial authorities to ensure transparency and protect investors' interests. Thank you.